Why small traders get trapped in the US stock market June 4th, 2026. Something changed in American stock trading. A rule that had shaped the way active day trading worked for decades was replaced. The famous $25,000 pattern day trader threshold was no longer the same barrier it had been. But this isn't a story about getting rich faster. It's a story about access. Because when a barrier becomes smaller, more people can enter. And when more people can enter, more people can discover just how difficult the game really is. Now imagine this. You have $5,000. You open your brokerage app before the market opens. One stock is moving. 8%, then 12, then 15. Your heart rate rises. You think, this could be it. You buy. For a few minutes, you're winning. Then the stock reverses. Your $300 profit disappears. Now you're down for 100. You tell yourself, I'll make it back. So you trade again and again until the money you came to grow starts disappearing instead. This is how the trap begins. And here's the first thing you need to understand. You've probably heard the headline, 90% of traders lose money. But be careful with that number. There isn't one official US regulatory study proving that exactly 90% of all retail stock traders lose money. What US regulators do say is much more useful. FINRA warns that day trading is extremely risky and that traders should be prepared to lose all of the money they use for day trading. So forget the viral percentage. Ask a better question. Why is short-term trading so hard? That's where the real story begins. For years, the $25,000 pattern day trader requirement acted as a barrier for any active traders. In 2026, that framework changed. The new approach moves toward intraday margin requirements and real-time monitoring, rather than relying on the old $25,000 minimum. That sounds like more freedom, and it is. But freedom doesn't automatically create better decisions. It simply gives people more access to the game. And that matters because small accounts have a very specific problem. Imagine having $5,000 and wanting it to become $50,000. That's 10 times your money, but preferably not 10 years from now. Maybe this year, maybe this month. And suddenly, normal returns begin to feel boring. A steady long-term return doesn't look exciting when another stock just jumped 20% in an hour. So the search begins. Options, leverage, high volatility stocks, short-term trades, and slowly, the goal changes. You stop thinking, how do I build wealth? And start thinking, how do I make money fast? That single change can completely transform how much risk you're willing to take. And then there's the phone. Your entire brokerage account sits inside your pocket. A chart moves. You see a notification. You tap, and you're in. Years ago, trading had friction. Today, the distance between an emotional reaction and an actual trade can be just one tap. And when action becomes effortless, impulsive decisions become easier too. Then comes FOMO. You're scrolling through social media. Someone posts, made $3,000 today. Someone else shows a luxury car. Another person says, this stock is about to explode. You weren't even planning to trade, but suddenly, you feel behind. That's FOMO. You don't buy because you've researched the company. You buy because everyone else appears to be getting rich. And by the time you enter, the easy part of the move may already be gone. Then something even more dangerous can happen. Your first trade wins. Maybe you make $200. You feel confident. You think, maybe I'm actually good at this. So your next position gets bigger, then bigger again. But one profitable trade doesn't prove skill. It could simply be luck. And when confidence grows faster than competence, position size can grow faster than judgment. That's where things become dangerous. Then you discover options. Options can provide significant market exposure for a relatively small upfront cost. But small upfront cost does not mean small risk. The SEC warns that an option buyer can lose the entire premium paid if the option expires worthless. Put $300 into an option, and you could lose the entire $300. That is 100% loss on that position. Then add leverage. Now you're controlling a much larger position with a smaller amount of capital. A relatively small market move can create a much larger financial consequence. FINRA warns that day trading on margin can produce losses beyond your original investment. Leverage doesn't just magnify profits, it magnifies mistakes. And then comes the most dangerous moment, the losing trade. You lose $500. You don't want to accept it. So you tell yourself, I just need one good trade. You enter again. Another loss. Now you're down $800. So you increase the position. Not because the opportunity improved, but because your need to recover became stronger than your judgment. That's revenge trading. Loss, emotion, bigger risk. more loss. And eventually, you're no longer trading the market. You're trading against yourself. But there's another reality most beginners underestimate. You are not trading in an empty room. You're participating alongside institutions, professional traders, and market participants with years of experience. They have research. They have technology. They have risk management systems. They have teams watching markets full-time. That doesn't mean professionals win every trade, but it should change how seriously you take the game. And here's something that should make you pause. Even professional fund managers struggle to consistently beat the market. According to the SPIVA US year-end 2025 scorecard, 79% of active large-cap U.S. equity funds underperformed the S&P 500 in 2025. Think about that. Teams of analysts, institutional research, full-time professionals, and still, nearly 8 out of 10 failed to beat the benchmark that year. So, when a beginner, trading part-time from a phone, expects to consistently predict which stock will explode next, the challenge should be obvious. And there's another cost people often ignore. Trading isn't simply about whether a stock goes up or down. There are spreads. There can be fees, there are taxes, there's slippage, and there's opportunity cost. Frequent trading can also generate substantial transaction cost over time. One trade might not feel expensive. Hundreds of decisions repeated over months can become a completely different story. Now look at the mathematics of a large loss. You start with $5,000, lose 50%, and you're down to $2,500. To get back to $5,000, you now need 100% gain, lose 75%. And $5,000 becomes $1,250. To recover from there, you need a 300% gain. That's why protecting capital matters. Because losses don't work symmetrically with gains. The deeper the hole becomes, the harder it is to climb out. And this brings us to the real trap. The trap isn't simply Wall Street. It isn't simply algorithms. It isn't simply market makers. It's the combination. Small capital, big expectations, one-tap access, FOMO, options, leverage, overtrading, revenge trading, and underneath all of it, one quiet belief. One more trade will fix everything. But the answer isn't to never invest. The answer is to understand what game you're actually playing. If your goal is long-term wealth, you don't need to predict tomorrow's stock price. You need a strategy you can sustain. You need to understand what you own. You need to manage risk. And you should never use money you need for rent, bills, emergencies, or essential expenses for high-risk trading. Because the market will create another opportunity. Tomorrow, next week, next month. But if you destroy your capital today, you may not have anything left when the better opportunity arrives. So next time you see someone online promising, turn $1,000 into $100,000, don't immediately ask, how? Ask, what could I actually lose trying? Because the biggest advantage a small trader can have isn't predicting the next big winner. It's knowing when the risk isn't worth the reward. So what traps small traders the most? FOMO. Leverage, options, overtrading, or revenge trading? Which one do you think destroys the most traders? Comment below and subscribe to MoneyVistaX for more financial stories, money lessons, and market psychology.